After studying this module, we shall be able to understand the meaning and scope of private equity in India, learn about the different types of private equities, namely venture capital and buyout, derive the skills to measure the performance or returns of private equity. For decades, private equity is the driver of growth. Growth and profitability are the primary goals of this industry. The contribution of the private equity industry to economic development is undeniable. According to a study done by Venture Intelligence, a research firm based in India in 2011, PE-backed companies grow faster in India. Such companies have recorded faster sales growth and higher wages than non-PE backed listed firms. This obviously holds the potential of adding significant value to the Indian economy. Private equity is now a vital part of our lives. When we buy a ticket at PVR cinemas, or when we book a ticket from Book My Show, or when we shop online at Mantra, or when we ride a Hero motorcycle, in all cases we are interacting with private equity. PE firm gets funds from various institutions, which includes pension funds. It also includes insurance companies. Wealthy individuals are also included. They invest that money in buying and selling the business. We shall now discuss the meaning and scope of private equity in India. Let us begin with the definition and meaning. Private equity organizations are defined as partnerships specializing in venture capital, leveraged buyouts, commonly known as LBOs, mezzanine investments, builds up distressed debts, and other related investments. This definition is given by Lerner way back in 1999. The European Venture Capital Association defines private equity as the provision of equity capital by financial investors over the medium or long term, or to non-quoted companies with high growth potential, and this explanation is given by Jan and Mann in 2009. Private equity funds invest in companies with the purpose of owning and operating them for some period of time. Private equity firms creates value by improving the operations, governance, capital structure, and strategic position of the companies in which they invest. The goal is to grow them, turn them around, and otherwise strengthen their performance. Private equity involves the acquisition of a private company with the intent of providing finance to take its performance to the next level. It may involve the acquisition of a division of a large company with the purpose of offering the management, focus or expertise to newly independent business and the resources needed to achieve organizational goals. It involves the methods of privatizing the public company. It is done to make improvement which are difficult to achieve. The reason is the short-term earnings is the main focus of the public markets. Now we will look at the scope of private equity. Venture capital private equity in India began in 1980 and early 1990s. The funds were made regional funds, for example, Gujarat Venture Finance Limited, and various first movers such as ICICI Venture and Actis Capital. The dot-com boom has led to a growth in venture capital actively in the late 1990s. A large number of funds was set up in India's Silicon Valley in Bangalore. An important aspect of private equity evaluation in India has been the reception accorded to it by entrepreneurs, especially in fast-growing SMEs. Increasing economic growth and competition in private equity gave various alternatives to choose from to the Indian entrepreneurs. India was the first of the most attractive markets for private equity investors till 2007. This was the result of a combination of the strong macroeconomic fundamentals and various other factors, including availability of growth capital, development of large enterprises, and emergence of entrepreneurs. Besides this, various conducive macroeconomic and financial policies adopted by the Government of India also helps in the contribution of the growth of private equity players. Until early 2001, the focus of private equity was skewed towards high growth sectors such as information technology. Since that time, with the slowdown of technology following the dot-com burst, they have diversified their interest into other high potential sectors such as manufacturing, infrastructure, e-commerce, pharmaceuticals, and biotechnology. Another effect of global slowdown in 2008-2009 has been the shrinking deal sizes for PE investors. There has been substantial corrections in valuation of Indian companies, and the extraordinary growth bubble has seemingly burst. PE investors have become more cautious and now appear more willing to invest in the traditional economy, seeking reasonable and steady growth. 2011 saw the PE industry start returning to the pre-2007 era with an average investment sizes of around USD 236 million, nearly equal to a similar statistic in 2007. More importantly, 2011 saw the rise of private investments in public equity, commonly known as PIPE deals, with a close to double increase in the numbers of deals struck. However, 2012 was another year of smaller deals. Private equity investment in Indian companies 2013, investment activity picking up during 2013 and 14. Let us throw some light on the form of private equity. Private equity market is a market for professionally managed equity investment in the unregistered securities of private and public companies. According to International Financial Services London, private equity is a type of equity investment in an asset in which the equity is not freely tradable on a public stock market. Private equity firms can invest in a wide mix of private investment strategies, with the mix varying greatly from firm to firm depending on the firm size, stated investment strategy, and industry and transaction expertise. There are primary 5 forms of private equity. One is the venture capital. Venture capital is a type of investment in which minority investment is made in a company with high growth rate with minimum revenues. Investments are made at an early stage of the life cycle of the company. It usually results in the acquisition of equity stakes in the startup business. These are known as high risk, high return opportunities. This method of investing is famous in new companies as they do not have any access to debt market to raise capital. Usually a venture capital at the time of exist accept a return of 100 to 200% on the amount of capital which they have invested. Growth potential or growth capital. These are the investments which consist of a private equity firm. It makes a minority and majority ownership stake in new company. Investment opportunities such as above take into consideration companies that are more developed than venture capital investment companies, thus making them less risky and less potential. These firms are in an outlook for attractive investment opportunities. They do this by going in depth through various industries and market trends. They are in outlook or lookout for companies where they can add a good amount of value and help them become market leaders. PE firms such as these offer strategic guidance, operational support, managerial expertise, accounting expertise, financial expertise, and efficient capital allocation to their investment companies. In a way, private equity brings a brand value to these unlisted small companies. These unlisted small companies are then come at a platform where world at large is aware of them. Leverage buyout. A leverage buyout is defined as the acquisition of a public or private company. It is done using a good amount of debt financing, which is relative to the amount of equity financing used. In LBT, a private equity firm, which is also known as a financial sponsor or a group of firms which are called a consortium, acquire the target company. They use debt financing instrument for the majority of the purchase price. Debt typically represent about 60 to 75% of the total price. Another point of information over here. In India, leverage buyout deals are very less as compared to other emerging economies which are included in the BRIC nations. Say for example China, the leverage buyout is a very important and very happening when it comes to buyout of a target company. TLB depends highly on the future cash flows of the acquired business to service the interest expense on the firm. Outstanding debt should be paid down as quickly as possible. As the debt balance is lowered, value of company increases, the equity grows as a proportion of company's capital structure. It is this deleveraging process that can help lead to substantial gains for the private holders in a successful LBO investment. Mezzanine debt. It is a hybrid financial instrument that combines the characteristics of the debt and equity instrument. It is debt capital that gives the lender the rights to convert to an ownership or equity interest in the company if the loan is not paid back in time and in full. A PE firm can offer mezzanine financing. It is given in the form of subordinated debt or preferred equity. Mezzanine financing many times involves compensation of investors. It is in the form of interest combined with upside participation. It is usually a more expensive financing source of a company. You can also understand this way of financing with the preference share capital. Like preference share capital, they are paid a fixed percentage of dividend, and they can also participate in the excess profits provided preference share capitals are issued under the category of participative preference share capital. This particular form of financing works as a layer of financing between a company's senior debt and equity. It also fills the gap between the two. It is a subordinate in terms of priority of payment to senior debt, but seniority is ranked to common stock or equity. Additional liquidity can also be obtained from equity investors. Equity is the most expensive source of capital. Equity capital dilutes its existing shareholders. Thus, mezzanine debt is an attractive alternative way to obtain much needed capital, with a word of caution that it is the most expensive source of capital, much more expensive than the equity capital itself. Distressed buyout. This type of investment involves purchasing debt securities that are trading at a distressed level in anticipation that those securities will have a higher market valuation and generate profit at a future selling point, or taking a position to potentially gain control of an asset. Prior to executing a distressed buyout opportunity, a distressed buyout firm has to make judgments about the target company's value, the survival, the legal and restructuring issues that may arise should the company's distressed assets need to be restructured, and whether or not the creditors of the target company will become equity shareholders. Various financial ratios are also used to define or to judge a company whether it comes under the category of distressed companies or not. We shall now throw some light on the performance or return on private equity. The prime reason pension funds, HNIs, insurance companies and other institutional investors invest their money in private equity fund is the exception of superior returns. Those superior returns helped strengthen several major public pension funds and defined benefits programs. But how do we measure the returns earned by private equity funds? Market participants use a variety of quantitative and qualitative methods to measure performance. However, the most commonly used performance measure is the internal rate of return, commonly known as IRR, that can be calculated at any stage of a fund's life. The IRR of a new PE fund depends on how that fund's or partnerships' illiquid assets are valued using various accounting methods. Venture capitalists have developed standard set of accounting principles, but the accounting method used to value non-venture investments are less uniform. In the case of VC, investments are recorded at cost unless they have been marked down at the discretion of the journal partner or marked up as a result of significant accounting policies. Third party transaction, for example, a subsequent round of financing involving a third party. In the case of non-venture investments, the appropriate markups are more difficult to determine because there are typically fewer follow-on investments from which the investment values can be updated. For both types of investment, more weight is given to the cash return of a mature fund than to the accounting returns of a younger fund. Here, one point needs to be understood, that it's very difficult to value an unlisted private company, not only in India but in any part of the world. And since venture capital invests in an unlisted private equity companies, it becomes a very challenging job to value a private equity company. Conducting a detailed empirical analysis of fund returns is often preferred as appropriate means for performance evaluation by potential investors and their advisors. Various factors that are considered include distribution of individual investment returns, relationship between individual investment returns and investment characteristics such as the industry, size and location of the portfolio companies, and the relationship between investment returns and the journal partners responsible for managing the investments. This is especially important if the partnership management firm has recently lost some key personnel. Qualitative assessment of a partnership management firm's skills constitutes another aspect to measure past performance. In cases where potential limited partners have co-invested alongside an earlier partnership, their previous experience provides investors an opportunity to observe how the journal partners structure and manage their investments, providing insights into the journal partners' management skills. Potential limited partners that have not co-invested alongside an earlier partnership may consult others that have and may even contract opportunities in which the journal partners have invested. Gathering and analyzing information on partnerships and their return is costly. As the private equity market expanded, a market for investment advisory services developed. Institutional investors who are new to the market increasingly rely on private equity advisor to evaluate partnerships. Various researches have been conducted to investigate into the performance of private equity partnership using data sets of individual fund returns and cash flows collected by various sources. We shall now recapture what we have learned so far. We have understood that private equity firms are the firms which raise funds from institutions, which includes pension funds, insurance companies and others. These also include wealthy individuals. The money is thus invested in buying and selling businesses. Private equity involves acquisition of a private company with the intent of providing finance to take its performance to the next level. It may involve the acquisition of a division of a large companies with the purpose of offering the management, focus or expertise to newly independent business and the resources needed to achieve organizational goals. It involves the method of privatizing the public company. It is done to make improvements which are difficult to achieve. The reason is the short-term earnings is the main focus of the public market. Private equity is now a vital part of our lives. When we buy a ticket at PVR cinemas, or when we book a ticket from Book My Show, or when we shop online at Mantra, or when we ride a Hero Honda Cop motorcycle, in all cases we are interacted with private equity. PE firms get funds from various institutions which include pension funds. It also includes insurance companies. Wealthy individuals are also included. They invest that money in buying and selling the business. The development of private equity aimed mainly at the funding startups and provide management support to such startups. Private equity firms create value by improving the operation, governance, capital structure, strategic position of the companies in which they invest. The PE industry in India is in transition. After a period of growth that began in the second half of 2011 and continued into 2012, there are signs of positive changes in the industry. There are primary 5 forms of private equity: venture capital, growth fund, leverage buyout, mezzanine debt and distressed debt. The most commonly used performance measure of PE funds is internal rate of return that can be calculated at any stage of fund's life. The prime reasons pension funds, HNIs, insurance companies and other institutional investors invest their money in private equity fund is the expectations of superior returns. Those superior returns helped strengthen several major public pension funds and defined benefits programs. The IRR of a new private equity fund depends on how that funds or partnerships illiquid assets are valued using accounting methods. VCs have developed standard set of accounting principles, but the accounting method used to value non-venture investments are less uniform. In the case of VC, investments are recorded at cost unless they have been marked down at the discretion of a journal partner or marked up as a result of significant third-party transactions. There is also a way in which a private equity firm exists from the company in which they have invested. And the most common route to make an exist by a private equity firm or a private equity partner is to bring an IPO of the holdings which they are holding at a premium, and thereby getting a huge return in the form of security premiums. The another way out to make an exit from the company, that they can also sell out their own stake to another private equity company. In this way, they make a profit in the company in which they have invested the amount.